shortly. While we wait, please take a moment to fully prepare for the presentation. First, make sure your audio is working. You should be hearing sound now. Also, please remove all distractions. The information we will be sharing is very important, and we want to make sure you get as much out of it as possible. And finally, be sure to have a notepad and pen so that you can easily take notes and write down references that may be discussed. Thanks again for trusting Trade Maestro with your trading education. We will begin shortly. For thousands of years, if somebody wanted to learn a new skill, maybe learn to make boots or horse saddles, how did they learn that skill? They studied with a master. Trade Maestro builds on this tradition, the relationship between the mentor and the apprentice, but we do it all online. The term maestro means master or an artist of consummate skill. And that's what a trade maestro is. It's a person who has mastered the art of trading. I didn't want to create just another stock market trading company that sells classes. I've done that, and I don't think that's in the best interest of my apprentice. I want to walk him through the process of becoming a great trader, and you don't get there with information overload. You get there by doing it, by getting your hands dirty, by putting into practice. That's the only way to build a new skill.
I love how Jeremy teaches. I love the fact that he teaches things in such a real, practical way.
And he made me realize that I can do this.
I remember when I first started my trading journey, and let's just say I blew up at least 2 accounts.
I know this model of learning to trade works. I've had the opportunity to work with people from over 80 different countries.
And I was skeptical at first. I was kind of like, okay, are you sure about this?
I was always chasing stocks. I would always chase the next top thing and never had an opportunity to get any profit from it.
I've helped people with trading accounts that are just a few dollars, and I've helped people with trading accounts that are over $1 million.
These courses give me a much wider perspective on what is really possible.
And what Jeremy does so well is that he breaks it down in a simple form so it's easy to understand.
They're just regular folks, and if I can teach them, I can teach you.
I didn't want to let someone else tell me what the play was, and I just followed their lead. I wanted to learn it for myself.
My greatest joy is when somebody that I have taught over the last decade, they reach out and they say something like, you won't believe it, but I actually have people that are asking me to teach them how to trade. Is that okay? You think I can teach them?
Working with you taught me that, stocks go through ups and downs pretty regularly and pretty predictable.
The portion that my husband has now been able to take over and own has outperformed the market and is doing better than the rest of our retirement. It is totally life-changing.
Just to think that I touched people, I taught them to do something, I influenced a generation of traders, and now they're taking it forward and they're influencing the next.
At the end of the trade, I ended up making 140%.
It just gives me so much delight and joy knowing that I can still do something with my financial future.
This is not something that's only for other people. I can actually become financially independent.
Not only allow me to make better trades, more lucrative trades, but have more confidence while I trade.
This Trade Maestro membership is excellent because it's got something for everyone. If you're just starting out, or even if you've been trading for a while, you'll find something you like. You need to get enrolled right now. It's affordable, it's comprehensive, and it's risk-free because you can cancel anytime if you decide you don't like it. So if you want to learn to trade the stock market, or if you're looking to take your trading to the next level, you need to get enrolled as a Trade Maestro member right now. The following presentation is for educational purposes only. All examples and analysis are intended for these purposes and should not be considered as specific investment or trading advice. All examples are for the purposes of teaching and are not intended to suggest future results. The risk of loss in trading securities, options, futures, forex, and cryptocurrencies can be substantial. Individuals must consider all relevant risk factors, including their own personal financial situation, before trading. Options, futures, and forex are considered more sophisticated investment vehicles due to high leverage and are not suitable for all investors. Well, good morning, and happy Friday to all of you. It's great to be with you on this fantastic Friday, April 25th, as we're rounding out another week of trading and another week of live streams. And this is kind of a significant one because today is going to mark the end of what we have been doing, what we started about a month ago. We did, I guess it was 5 weeks ago now. We started off with a week of live streams. We did 3 weeks of the Pick Winning Stocks Challenge, and then we've done a kind of a week of follow-up here. And next week, we're going to take the week off for a couple of reasons. Number one, I'm going to be out of town, and I figured it's just going to be too difficult to do the live stream the way we've been doing it while I'm on the road. And the second reason that we're not going to do it next week is because we're changing formats. As I've been announcing, starting, I do believe, on Monday, May the 4th. That is the plan. Monday, May the 4th. May the 4th be with you. We will be going live with Wall Street Secrets Live, the new format and the new show. And I'm looking forward to sharing that with you. And hopefully, Lord willing, the creek don't rise, as they like to say down south. Hopefully we'll be able to do all that starting on May the 4th, and we'll be ready for that. As I said, I'm going to be out of town all week, so got a few logistical things to get resolved before we do that. But next week, don't expect a live stream every day. I hate to do it. I hate to stop the momentum that we have, but I just think that it's going to be too difficult to pull it off. Doing it from a remote location with a small laptop and everything, it's just going to be a lot of moving parts. So hard to pull that off. Today, I'm going to share with you, after we do our market update and market overview, I'm going to share with you a model of retirement planning or portfolio management that I call the simple ETF portfolio model. Probably not the simplest name, but that's what we're calling it. And this is a model that I've been using now for really actively for 2 years, but I've kind of been teaching it in theory for about 3.5 years, and my students love it. And a couple of years ago, what happened is we decided to start tracking it live and start doing all that. So we do it every Sunday night, and it's part of our Sunday night profit picks. And I'm going to share it with you today. Share the whole big picture overview with you. This is something that you can do in your retirement account if you're managing your own 401k, if you're managing an IRA, if you are doing it in a self-directed account, whatever it is, if you have the ability to decide where your money is allocated, you can do this system and it will save you a fortune. Number one, because you're going to do better than the market, so you're going to make more. And number two, you're not going to be paying those pesky 2% a year fund management fees to those so-called professionals who can barely match and rarely beat the market. So I'm looking forward to sharing it with you and looking forward to get your feedback on this as well. I think you're really going to love it. Before we do that, let's jump in over here to the market itself. Let's see, that button didn't work. Let's try this one. There we go. Let's jump over here to the market itself, look at some charts, and see what is going on in the real world. Oh, that's why it didn't work. Now I know. Because, never mind. You don't need to know why it didn't work, but now I know why it didn't work. And it could be a problem moving forward today. All right, well, we'll deal with it. All right, take a look over here. We are down at the moment from yesterday's close, we're down right around 60. It's obviously it's moving actively. It's what happens on days like this. Live markets are always moving. But when you look at the candlesticks itself, when you look at the chart, you say that doesn't look like much of a big deal. And you're right. It's not much of a big deal. We talked about candlesticks earlier this week. We talked about this particular candle being a doji candle. And when it occurs at a turning point, it is very often the turn itself. Sometimes it's the swing high, sometimes it's the swing low. We'll give you another example right here where we had a doji happening right at our 20-period moving average, and that, in fact, did represent the top of that swing as the next day we started to swing back to the downside. We are doing another one of those right now, and this really stays consistent with my forecast. This stays consistent with what I've been saying all week and started saying last week, which is I'm expecting for us to stay kind of stuck in here. I think we're going to be stuck for probably another week or two. That's my intuition at this point. It's kind of hard to say because we don't have clear direction yet. But like I say, my intuition, just reading where we are and knowing how these patterns play out. As I zoom out a little bit here, you can really see this kind of consolidation. It's not a big named consolidation, but this little pattern starting to shape out. It might be in hindsight when we're done with this that we look at it something like that. You might call it a wedge or a pennant. Sorry, not pennant. You might try to call it a triangle. It's not a triangle. My words are getting all flustered here. What it will be is potentially a pennant on a weekly chart. So I'm zoomed out now to a weekly chart, and you can see this starting to shape up just like that. And if we were to see that same zig and zag for about 3 or 4 more weeks, yes, that's how long it would take, because each of these candles represents a week of data. If we were to see that for about another 3 or 4 weeks, then we're looking at mid to late May. And if it does it, and I don't know that it will, but I've kind of the inclination it will, because that's what it's kind of shaping up as. We will probably have a pennant on the weekly chart, and that's what looks to be forming right now. Now, it's early on. It's very early on, relatively early on. But like I say, back to the daily chart now, here's the pattern that's starting to shape up. If today continues and we start to do this again for next week, this is about what it would end up looking like. And it's not a triangle. Do not falsely label this a triangle. It would be a pennant on a weekly chart is what that would end up looking like. But it's a little early to tell for sure. Like I say, that's where we are heading at the moment. That's on the Dow Jones Industrial Average. Same thing is shaping up basically on the S&P, except today we kind of broke out. And I say kind of because it's not really a solid breakout. We are right here. We're establishing a new pivot area right here around the 5,500 range. And that's where we are today. So will we form into similar kind of a pattern here, except for maybe looking more like that, which would end up looking more like a different type of a pennant on a weekly chart? That's a high probability right now. The fact that we got a green candle and it's got a higher close than open, does that move us into the bullish category? Really not yet. No, very much not yet. We're stuck. I mean, we're really in the midst of a lot of pivot areas and a lot of resistance. Same thing on the NASDAQ. You can see right here where my cursor is. We're clearly establishing a new pivot here, right around 17,300. So we're going to have to just let it all work itself out. And that's, for better or worse, that's the nature of trading. The nature of trading is when we get to a turning point like this, you just kind of got to let it all flush itself out. And what we want as humans is we want to push through it. We want to just get it done really, really quick. One of the benefits of learning to read the different time frames and different structures is you start to get an idea of the pacing for how the rhythm goes of the market. If I saw this pattern on a 5-minute chart, I'd be sitting here saying in the next day or two, we're going to have a huge breakout. But I'm seeing it on a daily chart, which means it'll be in the next, 3 or 4 weeks, we'll have a breakout. But today we're not there. And that's why I can say with relative confidence, I feel like right now we're probably going to be stuck for the next 3 or 4 weeks. It's just kind of what it's shaping up to be. So obviously anything can change. We can have a big news announcement. We can have all sorts of things that would kind of push us in a direction one way or the other. But we are right now sitting right at the top, teeter-tottering back and forth, a lot of indecision. The bulls and the bears are relatively calm, relatively in agreement. One thing I want to point out here, which confirms the pattern that I am suggesting to you, if you can see it here, take it full screen again for you. If you can see it here, volume is contracting rapidly, very, very rapidly. This is a pattern of a little flag or a pennant. It's a part of the pattern is to have your volume contracting like it is there. So let's come back to the Dow. You can see it so clearly here. If you can see your volume bars here, very, very much. And now we went from being well above average volume to being well below average volume right now. Maybe kind of average for some of these days, but definitely a huge volume contraction. And again, what that shows is a lot of indecision. Now, if it happened in different locations, we might interpret it differently. But in this location, with what's been going on, that is the interpretation. So that sets you up, kind of wraps up the week for us here. It's why it's kind of a benign day. I don't expect big moves later in the day. We might, see a late day surge one way or the other. But for the most part, I think you're just going to see your week flush out and be done. Get into the weekend, and then we'll start fresh next week. And of course, if you haven't joined us for our Sunday night profit picks, you're going to want to do that this Sunday night. You need to become a member over at Trade Maestro. But we'd love to have you there. We'll go a little bit more in depth in some of the market analysis, and we'll go through all of our trade setups, top 10, all these different stocks, all these things in the watch list. I literally go through all that on a weekly basis there. All right, really fast, I'm going to touch on Bitcoin and crypto. Bitcoin, kind of to my surprise, did actually break through our pivot area, and it appears that maybe we're off and running. I was thinking there was a really good chance we would get stuck and cycle back down, but no, it seems like all the Bitcoin enthusiasts are ready to jump in right now. My only big yellow flag is we are starting to get overbought. Unless something slows it down, and there is definitely a possibility of slowdown right here in this 96 to 98,000 range. Definitely a possibility. But unless that slows it down, our next targets will be getting back pretty close to all-time highs, 105, 106, 107. And when we get there, expect it to cycle back down. Watch your stochastics come back down. And then when your Stokes turns back up, that'll be your next buy signal. Can we get to the all-time highs again with this wave? Yeah, we can. We absolutely can. Will we? I don't know that we have all the momentum for it yet. We need to see more volume coming in. It has come in. You can see the volume has started to come in here, but it's not come in like it does with the really, really big moves. And so it's building. We just need a little bit more. That's where we are on that. Ethereum, basically trying to put in the foundation, and it may be beginning that now, but we're still stuck in a lot of this muck down here. Nothing huge to report there. Same thing with these others, XRP, XLM, kind of stuck. Solana. I've been very excited about Solana. Very, very excited about it. It has not broken out of this resistance yet. Will it break out? Yes, I believe it will eventually. Will it break out this week? I don't know. Remember earlier in the week, I was forecasting this head and shoulders, and I think we may be seeing the top of that. Watch for it to come back to about 120 and make a turn. If it does that, you'll see your stochastics come down with it and make a turn. And when that happens, that will be a golden buying opportunity, especially as it crosses back above your moving averages. If that happens and it breaks out of the neckline, which this will become an angled neckline looking something like that, sell off and break back out, boom. That is a fantastic chart pattern and signal that is setting up. So will it all play out that way? We're going to find out. I mean, it doesn't have to pull back. There's nothing that says it has to, but pattern-wise and, momentum-wise, it would be better if it did. It would give me more confidence in the trade, but nothing says it absolutely has to pull back. So we'll just keep an eye on it. If we start breaking out of this resistance level, we'll just go with the trade. If it breaks out above about 158, 160, we'll just go with the trade. It doesn't have to put in the inverted head and shoulders. It would just be nice if it did. Be a little more confirming, All right, folks, that's my big picture market overview. I think that's all I need to report on, except for gold. Let me hit on gold really fast here. Gold continues to not make higher highs. It is establishing some support here on our 10-period moving average. Not a surprise, but when you look at your stochastics and you see that's heading straight down the mountain, I still think gold's going to pull on back probably as low as about 283 on the ETF. That's going to freak a lot of gold enthusiasts out. They're going to be like, what's going on? Why is it crashing on me? What's wrong with gold? Don't freak out. Recognize the momentum. Recognize what's happening. and then you'll be prepared for it. All right, folks, that's my big picture market overview for this morning / this afternoon. If you've got any questions on that, type it in here to the chat, either here over on Facebook, over on YouTube, or on Rumble. With no further ado, let's jump in and talk about our simple ETF portfolio model. Like I say, this has been a life-changing model for a lot of people. And I think it could change your life too in a positive way. It really just depends on the style of trader you are and what you're trying to accomplish. In fact, if you don't mind, I would love to know in the chat, what style of trader do you think you are? Are you trying to trade for your retirement? Are you trying to be more of a day trader? Are you wanting to be more of a midterm swing trader? I would love to know what you consider yourself to be. And maybe more importantly, what's your objective? What is your goal for your trading? Are you trying to take home monthly cash? You're trying to take home seasonal cash every 6 months or so? What is your goal for your trading? I would love to know that. If you don't mind typing in the chat. And those of you who watch the replay here, put in the comments. And maybe I can comment back and we can chat that way. All right, let's jump into simple ETF portfolio model. Of course, first principle of any portfolio is going to be diversification. So let's talk a little bit about diversification. What is diversification? Why do we do it? Diversification simply means that we're spreading the risk. We're taking the risk of one individual trade and we're spreading it over multiple issues. Now, no one trade should be able to take you down, and that's the whole philosophy behind diversification. If you become imbalanced in your investments, a lot of crypto traders do this. They'll be very heavy in one crypto, like XRP, like Bitcoin, or whatever it is you're trading. Might have 80% of your portfolio in that, or 90%. And that's an imbalance. That's not serving you very well, because what the whole idea is to balance it out so that as your account grows, one particular trade or one particular investment can't take you down. And you can take it from me. It's a very important lesson to learn. One that I took a little too long to learn in the early days. All right, ETFs by nature. Here's the cool thing about ETFs by nature. They are diversified. So this model, what's really unique about it is not only are we diversifying over multiple ETFs, we're diversifying within those diversifications. So with just about 5 allocations, that's the number right there, 5, okay? With only 5 allocations, you can be really quite diversified. It's easy to manage, it's easy to interpret, and you can do this. You can absolutely do it. And the benefit of this is you're going to beat the market most of the time, and you're going to beat those fund managers that are taking 2% of your funds. So that's the benefit of it. Now, for those of you who may not know what an ETF is, let me kind of break it down for you a little bit. An ETF stands for Exchange Traded Fund, and it's basically like a mutual fund, but it's going to trade on the exchange like a stock. So if you're familiar with the concept of mutual funds, you could go buy a bunch of shares of Disney, or you pool your money with other investors into a fund, and then the fund buys a basket of securities such as Disney, such as Microsoft, and a little Coca-Cola, a little Amazon, whatever they put into their fund, and that's your fund, and you own a little piece of that fund, so you have shares of the fund. An ETF is basically like that. An ETF is going to be like a fund, but instead of going to your broker and buying into a mutual fund, what you're doing is you're going to your broker and you're buying directly the ETF, which trades directly on the exchange like a stock. The difference in a stock and an ETF. A stock, what's backing the stock is ownership in the company. Whenever you buy shares of a stock, you are buying shares of the company. When you buy shares of an ETF, you're not buying shares of the company, you're buying shares of the fund. Does that make sense? That's the fundamental difference between these two issues. They're both considered securities, and the fund itself has bought more securities. It's just which vehicle are you buying? Now, if you think about this in terms of corporate structure, kind of talk a little bit of business to you here. If you think about an ETF versus a stock in terms of corporate structure, a stock is going to be a typical, typical corporate structure. So whenever you're buying into it, you're buying into the company itself, like a C Corp. okay? And you're buying part of that company. That company is an entity in and of itself. It is a legal structure called a C Corp. When you think about the ETF, it's a separate legal structure. And that's what it is you're actually trading. You're trading that legal structure of the fund. Instead of being a company, it's just the fund. That's all it is, okay? Hopefully I've explained that well enough. Now, ETFs by nature are diversified. By nature. That's just the natural state of an ETF. Why would you buy an ETF over a stock? Because the ETF itself is diversified. So when you think about some of these that I'm putting on the screen, for example, the Dow Jones Industrial Average, if you want to trade that index, you can trade ticker symbol DIA, and you're going to have exposure to all 30 companies in the Dow Industrial Average. That's what the ETF does for you. That is the benefit. Okay. If you want to trade the S&P 500, people say, well, how do I trade the S&P? You know, every day we start off and we talk about the Dow's up, the S&P is up. How do I trade those things? Well, you can't just trade the index on its own. If you want to trade the index on its own, you have to have a different vehicle to do it. A very good one would be an ETF like SPY, SPY. And when you buy into SPY as an ETF, it's going to give you exposure to all 500 companies of the S&P 500. It literally allocates that fund exactly like the S&P index. Now, if you don't want to trade the ETF, you know, the other ways you could get exposure to the index would be like through futures or other derivative products. But the most direct way to do it would be to do this right here, to buy ticker symbol SPY. It's going to have the appropriate allocation, the same way the index is laid out. It's going to lay out the allocation for all 500 of those companies, because it's the easiest way to diversify. You can use QQQ for the NASDAQ if you want to diversify over the NASDAQ 100. QQQ is the ticker for that. It's an ETF. The Russell 2000, IWM, diversifies you over 2,000 companies. You want to talk about diversification. 2,000 companies. Then you got a couple others up here. S&P 400 is MDY. It's 400 companies. You want to get into gold, GLD, which we look at, and then treasuries, TLT. Okay, that'll get you into treasuries. So here's the thing. Even if all you owned was SPY, you would actually be diversified. And by many accounts, you would be diversified enough. Now, I probably would not say enough, but you could be. And there is another formula that we teach, another management model that only trades SPY. It's a SPY-only formula, and it works extremely well as well. But this one, I'm going to give you just a little bit extra diversification just above and beyond SPY. And when we're done with this, you're going to say, okay, I get it, and I like it. So here we go. How much diversification do you think is needed? Well, that's a great question. How much diversification is needed? I've worked with some of my clients, and they'll open up their trading accounts and they've got 40 or 50 stock positions. And I just laugh. There's no way you can track all that. Not in actually remember what you did. That's just the reality. Whenever you think about diversification, having 40, 50 positions is just too much to keep up with. The truth is, I think about 10 or 15 becomes about as much as you can handle, even for me. I mean, I don't want to manage more than 10 or 15 positions. It's a lot. So more than 10 or 15 trades becomes a bit overwhelming. And when we think about our ETFs, each of those ETFs is already diversified. They're diversified. All of them. They're all funds. They're all diversified. And so all the diversification you need can really be summed up in about 5 trades if we're using ETFs as the foundation for it. And that's the key right there. I'm not saying that, if you go out and buy Apple, Amazon, Nvidia, Netflix, and Google, you got 5 stocks, so now you're diversified. That's not what I just said. I did not say that. I didn't say you only need 5 trades. I said if you go buy these 5 ETFs and you rotate them the way that I'm going to show you right now, you will have diversification. And that's all I said, okay? So the ETFs in and of themselves are diversified, and then we're going to diversify over 5 others. So with that said, let me introduce you to the model. And the model is kind of a rotating model where we're moving from one fund to the next based on what the market is doing. And I'm going to give you the flow right now. You might want to take a screenshot or write down on a piece of paper what this flow is. So there's a SPY rotation that we do, which I won't get into right now, but we're going to do the exact same philosophy with more than just SPY. We're going to divide our account up, and specifically, we're going to go with 20%. We're going to take each allocation and we're going to go through the rotation model, and you're only going to be in 5 trades at a time. Okay, so we're going to divide the account up by 20% each, take each allocation through a rotation, and we're going to be in 5 trades at a time. You say, what are the trades? Here they are right now. You ready? There's the division. There's the allocation. The allocation is 20% in SPY, 20% in one of 3 sectors, which we'll talk about in a moment. So sector 1, sector 2, sector 3, and then the final 20% in commodities. That's it right there. For those of you, I know I got a couple of you on here that are in my Sunday night group. When we talk about the ETF portfolio, this is the model that we're doing. So with a SPY allocation, we're talking about the 20% that's allocated to SPY. It's either going to be in SPY, that is the S&P 500, treasuries, or cash. SPY, treasuries, or cash. You say, well, which one is it going to be? I'm going to tell you right now. When the SPY, that's the S&P, when it meets the criteria, which is to be above our averages, and the averages are green. When the SPY meets the criteria, you put 20% into SPY. When it does not meet the criteria, you go look at TLT. That's treasuries. If treasuries and SPY are neither one in a bull trend, then we go to cash. And if you only did one segment, this is the one I would do. This is the most diversified that you can do. It's the most like kind of risk on, risk off. So let me show you. We're going to go do this right now. I'm giving you the theory, and then we're going to go do it. And since I messed up, there we go. This will work. So what we're going to do is we're going to pull up SPY. And you guys have been learning with me now for a week or two. A couple of you. It just depends on how long it's been since you came in. But if you came in last week or 2 weeks ago and you started doing the Pick Winning Stocks Challenge with me, then you learned about these averages. And you learned when we're above the averages, we're bullish, such as right here. And when we're below the averages, we're bearish. Okay, so when the price of SPY, when it's back above these averages, which it's not right now, and the averages have turned green, then it's a buy signal. That's what I'm talking about. That's the confirmation you're looking for. So right now, we're not there. Right now, the averages are red. If I were to get rid of the lines themselves and you just see the color, here's what it looks like. So we're not green. It's not a buy signal right now. That's why I keep telling you every day for the last couple of weeks, nope, we're not buy. You say, well, should we be short? No, we're actually not short either. This is very neutral. It's kind of one of those frustrating market conditions. But let's say that we're back over in this situation right here. Okay, so the right side of the chart, you can see it was red, and then we crossed back above all the averages, and the averages just turned green barely on the right side of the chart. So then if we scoot it over, you say, what happened? Well, we had ourselves a little bullish trend. So when you're back above the averages and the averages are green, we are in our bullish trend. It's a buy signal for SPY. Buy the SPY. And you're going to hold it. So this is as close to a buy and hold strategy as I'm going to teach. We're above the averages are green, you position yourself and you take that position. Now you notice this signal came back last August, and we did not get a red signal until barely we got one in January, then it was green again, and then we got our solid red signals in February. So August to January, what is that, 4 or 5 months? And then we had a month, kind of a whipsaw month here. That's what I was talking about yesterday, where I said we had a lot of trades that confirmed and then they unconfirmed. that happened a lot in late January and February this year. So we had some break-even trades. We had some couple losses. And then we got into this bear trend. Okay, now when you're in a bear trend, you just stay out. So how this allocation goes is if you're in a bearish trend, we're below the averages are red, you just don't trade it. Don't do it. So where do I go next? Okay, so step one is check the SPY. If SPY is bearish, we go to TLT and we check treasuries. Okay, so let's go to TLT. So we'll pull up TLT. And TLT is an ETF for treasuries. And when we look at this, based on what you just learned, based on what you know, are we above the averages? The answer is no. Are the averages green? The answer is no. So treasuries are not bullish. So where do we go? We stay in cash. There's nothing to be done. We stay in cash. And that's the first 20% allocation right there. You're either in SPY. If SPY is bullish, we're in SPY. If it's not bullish, we go to treasuries. If treasuries are not bullish, we go to cash and we stay there. And that's where we are right now, by the way. Okay? So that is the first allocation, is the 20% that goes to SPY. If you got any questions about that, type it in. Bill says he likes to swing trade and he likes to sell puts mostly. Good for you, Bill. He says, are there some kind of taxes or hidden fees on ETFs? Not specifically. There's some management fees, but they're just minuscule. You won't even know that's happening. And as far as taxes, it's going to be like anything else. And if you trade it, Bill, you're of the age that you could trade all of this in a Roth IRA, and you can actually trade that tax-free. So why don't you just do that, Bill? Makes sense. Easy for you. See if we got any questions over here on Rumble. We do not. Got some people hanging out, but no questions over there. All right. All right, so that's the SPY allocation. Now let's move over to the other 20%, or the next 20%, which is commodities. And we're going to take 20% and we're going to put it in one of the commodity ETFs when the bullish signals are met. So 1/5 of your portfolio will go into commodities. You say, well, what if all of the funds are bearish? Then what do we do? And the answer is you go to cash. And this is really important in my opinion. Do not take this 20% and allocate it to anything else. No shiny pennies is what we call them. No shiny pennies. You say, why not? Because you are then overexposing yourself to other sectors. That's why. So the first 20% is going to go to SPY. The second 20% is going to go to a commodities allocation. You say, which one? Well, whichever one looks the strongest, and I'm going to go through the ETFs here in just a minute. So I'll give you the ETFs that we use for this in just a moment. But before we do that, let's talk about the top 3 sectors. Here's how the top 3 work. So we're going to take of the remaining 60%, we're going to take 3 more allocations, 20% each, so 60% total, and we're going to place it in the top 3 sector ETFs at the moment. And if there's more than 3 sectors that are strongly bullish, you're going to pick the 3 that you think look the most bullish. The truth is, if they're all looking bullish, then you're probably not going to pick too terribly. Would maybe one outperform the other? Yes. But if they all look equally bullish or similarly bullish, just pick 3 and they're going to be fine. If you start dropping, if any of those start dropping below the averages, you get out and you move to another one that is bullish. And if you don't have 3 of the top 3, if you don't have 3 of the sectors that are bullish, then you hold it in cash. The end. Now, this is going to take a lot of discipline from you, and this is a discipline that most of you don't have, but it's the discipline you need. Unless you're doing bearish trades. Now, if you're doing bearish trades, it's different. But if you are a traditional long-term trader, you're wanting to just position your money and move it, a handful of times throughout the year, this is one of the most efficient models you can do. Okay? So, here it is, all on one screen. This is an example. Okay? So, let's say that you do your analysis, and for your first sector, SPY is bullish, you buy SPY. 20% in SPY. You do your analysis on the commodities and you say, well, gold looks the best, so I'm either going to be in gold or cash. Okay, if you don't want to take the gold trade, you stay in cash. Then you look at your top 3 sectors, and let's say hypothetically XLI, XLF, and XLK were the 3. And if that's what you chose, then those are going to be the 3 you take. Okay, we're going to walk through those in just a minute here. But this is what it would look like. Now, if XLI or XLF or XLK drop below their averages and it's not looking bullish anymore, then you move to another sector that is, or if there's none of them, you stay in cash. And that's where we've been for the last, several weeks now. It's been kind of annoying for a lot of people because they're like, oh, we want to be invested. No, it's the wrong time. And we've been saving them money because they would have been in a lot of trouble. Okay. So here is, let me go, hold on before I do this section, because I do want to talk about this, but let's go over here to our charts. And actually, forgive me, I'm trying to remember. I should have had this memorized, but I can't remember where I did the sectors. Did I cut them out? I think I did. I messed up, folks. So let me give them to you. If you'll just stand by, what I'll do is I will find them here. I somehow did not put the spreadsheet with the sectors in here. So if you give me one moment while you stare at this screen and laugh at my, apparent lack of organization, I will find them because they are right here under this right here, I do believe. Here it is. All right, so I did the favorite index ETF. Somehow I cut these 2 slides out. All right, here's your commodities. This is the commodities that you need to take a screenshot of. Gold, silver, oil, or gas. Those are the primary ones. And if you want to move outside of that, solar. And then I stuck treasuries on here, so we had it on the spreadsheet somewhere, but it's not a commodity. All right, so gold, silver, oil, gas, or solar. We're going to use GLD, SLV, USO, UNG, and TAN for solar. Okay, let's stick with that right now. Let's go over to our chart and let me walk you through how this looks. So we've already allocated SPY right now. If I were to just sit here and draw this out, and we were to say, okay, here's our pie. We're going to do a 20% to SPY. What did we answer? Well, let's walk through it together. SPY is bearish. So we move to treasuries. Treasuries bearish. So we go to cash. So the first 20% is in cash. Now we're going to look at the second 20%. And the second 20%, so that's going to be cash. Second 20% is a commodity. So we're going to do the same thing moving through the commodities. So we said gold. Well, quick glance. Is gold bullish, bearish, or nothing? And the answer is it's actually bullish. Okay, so right now gold could be your allocation for this. And it would be fine. It would be a very logical decision. Let's take a look at silver. Silver, maybe. We just recently crossed back over, and I could get behind it. It's at least matching the criteria. The only yellow flag I have on silver is that we're running into resistance, so I would actually say gold's probably a little stronger. Let's take a look at USO. USO, which is oil, is bearish. It's below the averages. The averages are red. So it's a no-go on oil. What about natural gas? Natural gas is something I'm very optimistic about right now, but no. It's a no. Because the criteria is, are we above the averages? The answer is no, we're below them. Are the averages red or green? They're red. Okay, then we look at solar, and solar is perpetually bearish right now. So you're down to gold or silver. If we want to take any commodity allocation, it's gold or silver. Gold looks stronger than silver right now, and it has been. That's why we've had several trades on it. If you didn't know, I'll turn these back on. Our most recent entry was at 272, just so you know, in case you didn't know that. I'm a little concerned that gold's overbought and it's pulling back. I might be inclined to take the risk on silver because I think it has a little bit more upside potential right now. However, what I don't like about silver is I do see this solid resistance at 31.50. It's really a three-way choice. You could either hold this allocation in cash and wait for a pullback and a continuation in gold. You could take the silver trade, or you wait for silver to break out, then you take the silver trade. Or if you want to just go with the one that is currently the most bullish, go straight to gold. So it's a three-way tie for that allocation, and none of them are going to break the bank, whatever happens. So it's a good decision, really, whichever way you go. And that's the way this decision tree needs to go. It needs to be like, okay, even if I take a gold trade right now, and maybe it is a little high, it's not going to break the bank. It might pull back a few dollars, but this is a solid trend. It hasn't reversed. This is a very reasonable trade. And the percentage of risk that you would be taking on this would be minuscule, relatively speaking. In fact, I can give it to you right now. Hypothetically, if you were to buy gold right now at $303, let's make it 304. I'll give you the formula for it. Let's just say that you're doing a $2,000 allocation. So that'd be 20% of a $10,000 account. Okay. So you say $2,000 divided by 304, you would be buying 6.5 shares. So you're going to get 6 shares. Okay. So 6 shares times 304 means you're actually putting 1824 into this trade. So let me write that number down. 1824. Now, if this thing starts dropping below your averages, and those of you who know my system, you know that I don't just go with the lowest average. We're going to put your stop up here, below your 10 period or your 20 periods. Let's go with 20. We'll leave a little more risk. That's 296.50. Okay. So if we sold, let's say that we ended up stopping out of this trade at 296.50. 304. Well, let's just go 296.50. 296.50 times 6 shares, 1776. If you took this trade right now with a $2,000 allocation, that would be 6 shares. It's 20% of a $10,000 account. And you stopped out on it. 1824 minus 1776. You'd only lose $48. Can any of you not sustain that? The answer is you can all do it. It's well within our risk tolerance. It's such a minuscule amount that you shouldn't even be afraid of it. That's what I love about this portfolio management model is the risk that we take is just really, relatively speaking, very, very small. Okay. You can have a lot of losing trades where you only lose $48. You can sustain a lot of those, right? So I just wanted to show you exactly what that would be. And the silver trade would be similar. Generally speaking, on a $2,000 allocation, which I run this a lot for the $10,000 account, on that size of an allocation, generally your drawdown is going to be somewhere between $50 and maybe $200. It's the most you're going to get. It's just nothing, relatively speaking. Okay, some of you are taking huge drawdowns right now. Some of you are taking, on a $10,000 account, you're taking $1,000 and $1,500 hits. Not with this model. Okay. So that's how we do that one. Let's just say we did that. Let's just draw out the theoretical portfolio right now. So the first 20% is cash. Second 20% is gold. Now, what about the next 20%? The next 60% will be divided into 3 20s. And let me give you the trades that you're going to do for it. We're going to choose between these ETFs. These are, I call them the X's. It's all the sectors. XLC is communication. XLY is discretionary. XLP is consumer staples. XLE is energy. XLF financials. XLV is healthcare. Industrials is XLI. XLB is materials. Real estate is XLRE. Technology is XLK. And utilities XLU. So you're going to take those guys, and we're going to do the exact same thing that we just did with commodities. Now I've got them all set up right here. So I literally just go down the list and I'm looking to see what are my 3 top performers. So let's do that. XLC. Nope. We're stuck in the middle of the averages and the averages are red. The answer is no. Discretionary. Nope. We're in the red. XLP. Maybe we're actually kind of above the green and maybe, the price today has dropped below it. So I'm not loving XLP. But it is actually a possibility. XLE, nope. XLF, nope. XLV, nope. XLI, nope. XLB, nope. Real estate, nope. Tech, nope. XLU, maybe. We're above the averages, but they're not green yet. And that, ladies and gentlemen, is why currently in our allocation that we've done publicly, which is what we do on Sunday nights, that's why we are all cash. We're all cash because none of the allocations actually make sense right now, today. Okay? In a perfect world, we would be in 3 of those, but we don't actually have 3. So right now, this is what it looks like. Cash, 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 gold. And this gold is questionable. This one could just as easily be cash today. Only because it's really high and it's starting to pull back. And most of my guys already took profits on it. So most of my people are probably back in cash. But that's the model right there. You say, well, I don't want to just sit in cash. Yeah, you do. When the market's going down and you're bullish, if you're bullish only trader, if you're not trading short and you're not buying puts and you're not doing bearish strategies, the best thing you could do in a bear market is be in cash. So you might think, oh, I need to have my money invested. Let's buy the dip. No, what you need to do is you need to protect you need to CYA. You need to protect your hiney. And this is why people lose so much money in a bear market like we've been in right now. Because if I come back over here to SPY and you look at this, most people are holding through this or they're doubling down right before the drop. They're always on the wrong side of the trade. If you'll wait, and you can go back and do this. I went through this with you a couple weeks ago. Go back, get my indicator. For all of you who are Trade Maestro members, you get this indicator. Go back to 2020 and follow every time SPY is above the green and it's green. If I were to buy and I were to just get out when it drops down, buy, get out, buy, get out. If I go back to 2020 and I do that, what's the result? And I'm going to tell you right now, the result is about a 65 to 70% win. Number one. So 65 to 70% of your trades win, and you far outperform the market. And you will continue to do that if you follow this system. This system right here is biased bullish. It will keep you in the majority of the trend for the bullish trades. It will help you outperform the market, and it will CYA. It will cover your butt in a bear market. It will get you out if you follow it. And if you then take that system and you roll it out over this 5 ETF sector model, and you rotate, when one goes bearish, you rotate it into another bullish one. If you will do that, you'll outperform the market. It's the simplest money management technique you've ever seen, and it just freaking works. It just works. So now what I got to do, because I messed up my slideshow, I got to get back to the one that I meant to be on. My apologies for leaving those out. Let's wrap this thing up. So simple portfolio management model. Follow this simple top 5 rotation model. Do not allow more than 5% drawdown on any one of the individual positions. Okay? That's 5% of your overall account. So on a $10,000 account, you can lose as much as $500 on one individual trade. I went through risk management last week. So don't allow more than 5% drawdown on any one of the individual positions. And if you do this, this will manage your overall risk absolutely perfectly. Like I said, most of our trades, we keep it to 2% or less for the vast majority. The only ones that really, with this model, the only ones that get beyond that are when we use leveraged funds, which we didn't talk about today. But you can pretty much always keep it below, almost always below 1 or 2%. What's this worth to you? What's it worth to you to learn how to do this? Well, I'm going to put some real numbers on it. Okay. If you're managing $10,000, this is probably the only way that you get a solid money management formula that you can do that a so-called professional would not be able to perform for you, because their numbers stink. And you know that. You've seen me show them to you. Okay. So if you're dealing with less than $100,000, you're not going to be able to attract the kind of professional fund manager that you want, that you need. You're not going to get a top 10 manager. Probably if you're dealing with $100,000, you're not going to get a top 10. You're going to have to be dealing with $500,000 to $1 million or more to get a top money manager to work with you. Okay? So that means that either you're settling for a mediocre fund manager or you learn to do it yourself. And this is what I have helped people do for years, is learning to do it yourself, because you can. You've seen now how simple it is. You might need a little coaching. You might need a little, hand holding, couple tweaks here. But let me put this in perspective for you. And we looked at this yesterday. If you were to do this on your own, instead of letting somebody else manage it for you, if you did it on your own, just with the drawdown that you would have avoided this year, it's $22,000, and you add in a 2% management fee on a $100,000 account, that's a savings of $24,000 of financial pain. You carry this out, you got $250,000, $500,000, $1 million. It's a substantial savings of emotional trauma that you can avoid by learning to do this on your own. And that's why I teach it. That's why I have taught literally thousands of people now how to do this, because it's worth it. Most people don't realize their fund managers are underperforming. And those who do, still most of them don't realize how much they're spending in management fees for a lack of performance. And most people don't realize that you never needed to see a $220,000 hit on $1 million account. And that is the number. That's a real number. Some of you might have $1 million in your retirement account right now, or your trading account. You might have $1 million that for the last 5 weeks, you have watched absolutely flush out of your account. And you can't stand the idea of opening it to see how bad is it. Now, if you hold on long enough, will it come back? Probably. But we could have avoided that. Imagine closing that out, and instead of having a $220,000 hit, imagine you closed it out relatively close to the top whenever the trends changed, and maybe, it's $20,000 less than your original peak, but not $220,000. And then as you got back to the bottom and we start to get the buy signals, now instead of buying back in holding through, now you're buying back in at a cheaper price, and you can buy 15% more stock. And as it gets back to the peak where you would have had $1 million, now you're going to have $1.2 million. That's money management. That's portfolio management. And this model will help you do it. The one that I shared with you today will help you do that. Okay? So I have an announcement. I just sent out an email about this morning. For those of you on my email list, you would have seen it, but we've got an April breakthrough sale for this weekend. It's kind of a flash sale that we decided to put together. And here's what's going on. Limited to this weekend only. For those of you who decide to become a Trade Maestro member this weekend, and I don't usually do this on the live stream, but I wanted to do it today because it is a big promotion we're doing. When you become a member this weekend, it's kind of like a BOGO. It's kind of like a buy one, get one. You're going to get up to $5,000 of private one-on-one coaching with me included. Now, normally I do this completely separate. That's why this is like a BOGO. That's why this is a special deal. I sell my membership. It's $97 a month. Or if you want to do an annual membership, it's $970 a year. And when you get your membership with Trade Maestro, you come in every Sunday night, every other Wednesday night for group coaching, but every Sunday night we do live profit picks. You have access to the entire trading library. It's like 400 videos or something at this point. And you have access to me, all that great stuff. Okay, but that's the membership at Trade Maestro. Private coaching is a completely different deal. Private coaching is a different deal. And what I'm doing right now is with each of the membership levels. If you do a monthly membership, you get one coaching session. If you do an annual membership, you get 2 coaching sessions. If you do a 5-year membership or a lifetime membership, you get more coaching, all depending on the membership that you enroll with. So I put the link here in the chat. I will put it in the comments whenever we're done with this, and you guys can go get signed up for that. If you have any questions about it, obviously reach out. I'll be happy to help them for you. I hope you've learned something today. I hope you've learned something this week. If you have, like and subscribe. Follow over on Rumble. Like and subscribe so you get the alerts whenever we go live next time. I want to remind you, next week, I'm not planning to do live streams next week. I will be out of town. And we're also in the middle of this transition as we're shifting away from what I've been doing for the last few weeks. And we're going to move into this new format that we're calling Wall Street Secrets Live. My plan is to launch that on May the 4th. May the 4th be with you. Yes, I can't help but say it. So my plan is to launch that on May the 4th. That is a week from Monday. So we'll basically take next week off. And then May 4th, we will jump in and do it. So like and subscribe and follow if you're interested in becoming a member over at Trade Maestro. When you enroll, you will get your email welcoming you. You will start getting the emails inviting you to the Sunday night groups and to the group coachings that we have. And of course, you can go anytime instantly right into your membership area and start watching videos. All right, check it out over at trademaestro.com. If you have any questions, please reach out. help@trademaestro.com. help@trademaestro.com. Thank you for being here. I wish you all the best. I hope you have a wonderful weekend. Happy trading to all of you. I'll talk to you live. I'll be back May the 4th. That is the plan, May the 4th. So until then, I hope you have a great week, and we'll talk to you soon. Have a great day.